The daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management.
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. Today, we have Mr. Nate Pyle. He's founder and editor of Nate's Notes. Nate's Notes is one of the nation's top-performing investment newsletters, which is independently tracked and rated for actual profitability by Holbert's Financial Digest. According to Holbert's ranking, Nate's Notes has consistently appeared in the top 5 for real returns in the last 5 years. Mr. Pyle is a frequent contributor to Forbes.com, MarketWatch.com, and has been recognized for a stellar track record performance in Barron's. Nate, welcome back to Market Wrap.
Thanks. Good to be here. Happy New Year, Mo.
Happy New Year to you, too. Let's start by looking at the new year. It started out well so far. The first day was good. Today was sort of mixed. What is your overall outlook for 2011?
It's dependent sort of on I'll put myself in the wishy-washy camp. I just admit that right up front.
Okay.
There's a lot of strong fundamentals I see in place for certain companies.
Mm-hmm. Now, you talked a little bit about housing and interest rates. Do you think the interest rates have bottomed and we are heading higher in the interest rate cycle?
That would be my guess. It's not my area of expertise, but of course I do follow it. But it does appear to me that we've probably hit bottom and are starting to creep up again. The good news out of that is once the cycle finally turns and people realize they're headed higher, it will spur some more home buying, in my opinion. But once that first wave of buying is over, as people try to lock in the low rates before they head up, I think you're going to see us run out of buyers for real estate again. And then, of course, the equation gets that much more tricky with the interest rates being higher but house prices still falling.
Let's talk a little bit about the sectors you like. What do you think will perform well this year, short and long term?
Well, provided we don't have a double dip, which is looking less like, but still possible, or a market panic, which may happen given that we've basically gone straight up since September. And usually when buyers come in that quickly, they're just as fast ahead for the exits when things turn sour.
Talking about high tech, there's a lot of people saying that this is the year for high tech, and there's a new era of personal computing that dawns with the tablet and the iPad and mobile computing. Do you think the average investor is ready to ride another tech stock wave?
Well, thus far it looks like they are, with the caveat that I'm not sure if the individual investor is actually in the market all that heavily right now. I don't know if you've had a chance to look at my latest issue or not, and I would like to make that available to your readers. One of the things that struck me as odd over the last year, that's the first time I've seen it in my 22 years following the market, is that we seem to be getting into these streaks where we just pick a direction and the market heads nothing but that direction for 2 or 3 or 4 months. And I don't know if that has to do with institutions sort of dominating the trade, and they've all switched, or not all, but a lot of them switched over to computer-based trading, and they're just looking for trends and then following them. But as we've seen again with cycles that go on, as they pick up momentum, they tend to feed on themselves until they reach those frenzy points when everybody wants in, and that's actually the time to get out. I think that barring some event that triggers a sell-off over the next few weeks, it is shaping up that we could start the year off with a bang. There's just
that could be
not
good.
A lot of volume in the market right now, and people do seem interested in buying stocks rather than selling them at this point in time.
Yeah, there's a lot of money for the first time in about 33 months. We're starting to see positive flows into stocks and negative flows out of bonds, where everybody was buying bonds. Now they're selling some of those bonds and getting into the stock market, which is good. Looking at your model portfolio, it's up 592.9% since the inception. Your aggressive is up about 13%, 1,300% since its inception in 1997, while the Dow is up 54% since 1997, and the NASD, the NASDAQ, is up 66% approximately in the same time frame. So, Mr. Pyle, let's go further and talk a little bit about What about large cap, small cap? There's been the first seasonals where the first year, part of the year, the small caps lead, but a lot of people are saying this year is going to be the year of the large cap stocks. What is your opinion on that?
Again, with the caveat, it's hard to say what's going to happen over the next few weeks, which I think will dictate how the rest of the year goes. I think provided the market stays strong, you will see the small caps outperform the large caps, simply because when we get into these feeding frenzies for stocks, they have that much more room to run. That doesn't mean you can't see some large companies also make nice gains, but starting at a 20 or $40 billion market cap, it's just hard to grow as much as you can if you start at a $400 million market cap when people go crazy for stocks. So if the market stays strong, I think that the small caps will probably outperform. And in fact, a lot of that outperformance might come from the larger companies spending some of the cash that they've built up to just buy these companies outright.
In your latest newsletter, Nate, you talk about a recent phenomenon where the market seems to be picking a direction and pretty much trading in only that direction for an extended period of time. Example is in September, we've had this melt up in the market. How can you explain what does it mean to investors that we see this sort of one-directional trade for a period of time?
Yeah, well, as I mentioned a little while ago, it's the first time I've seen it to this degree in the little over 2 decades I've been following the market. And there's probably a variety of reasons. The one that seems most logical to me, without having any data to back it up, is just that a lot of the institutions are adopting program-based trading, and of course the programs are more or less designed to look for trends and then follow them. Of course, as we saw last night in the flash crash, the risk with this is that they often take on risk piece by piece, but once their models start to say it's time to unload risk, they're willing to do it at just about any price, simply to take the risk out of the equation. And with the way the market's gone up, there hasn't been much profit taking, and though I can think of a lot of reasons to be bullish for the coming year, 90% of the people I've seen on CNBC over the past 2 weeks have said the same thing.
Right.
And usually when everyone's looking for a good year in stocks, it doesn't materialize for one reason or the other. So though I'm fundamentally bullish, there's a part of me, the big picture part of me, that's saying, wow, we're all kind of looking for the same thing. And that's why I'm still carrying quite a bit of insurance in the portfolio.
Yeah, looking at, you have some core stocks in your portfolio, and then you have the other stocks. What is the difference between the core stocks that you have, Nate, and the other ones that you have?
Yeah, excellent question. There's about 20 stocks in the newsletter,
right,
which is what I stick with, and I try to hold them for anywhere from 3 to 5 years, but I've had a few of them for, since I started the newsletter back in 1995.
Right.
The core stocks are stocks that I feel really represent a great long-term value, and buying them anywhere at today's prices, basically in this time period, looking out 5-10 years, those are the stocks you probably are still going to want to own. Doesn't mean the other stocks aren't also worth looking at, but they don't have as much, not sure what the right word would be.
Let's ask one more question. As you said, the question, everybody seems to be bullish right now, and that thing concerns me a little bit right now, that everybody in the world is bullish. All the fundamentals look good. We have earnings expected to go up. What worries you that could go wrong besides everybody just running out of buyers?
Well, on a fundamental level, I'm concerned that it's not just the pigs countries that have issues with sovereign debt, obviously, and at some point the people might start to be concerned about the countries outside, Portugal, Ireland, and whatnot. Mm-hmm. Either a geopolitical thing or, again, just some concern about the whole debt and deficit spending and whatnot, and people realizing that it's a bigger problem than just those 5 countries over in Europe.
Nate, I want to thank you for taking the time out of your busy schedule and being with us today and sharing your thoughts with us. That's Mr. Nate Pyle, founder and editor of Nate's Notes.